This episode of Macro Mondays aired live at 12:30pm on Monday the 9th of December. Tune in Mondays at 12:30pm UK time to watch Macro Mondays live.
Hello and welcome to Macro Monday. My name's James Brodie and I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
Today, again, we'll be discussing key macro charts and market trends. We'll look at the reaction to the weaker than expected data out of the US last week, and we'll also discuss the many central bank meetings coming up over the next 10 days.
We'll look to the east and see how Chinese bond yields are remaining low at their multi-decade low points, and deflation worries continue in China. We'll also look at the impact of the PBOC restarting its gold purchases after a 6-month break.
So let's start with last week's data. In the US, the big data was on Friday, the non-farm payrolls. The headline came in higher than expected, 227,000 jobs created, but the unemployment rate unexpectedly rose from 4.1% to 4.2%. Actually very close to 4.3. To 3 decimal places, it was 4.246. So the market took this as bad news. However, the data was fairly mixed because of the impact of the Boeing strike and job recoveries from hurricane-affected states like Florida and Georgia. But if we look beyond the BLS, Bureau of Labor Statistics data, and we look at the household survey, you can see here the data does come out particularly weak. Full-time jobs fell 111,000 and part-time jobs fell 268,000. In fact, over the last 12 months, 1.34 million full-time jobs have been lost. Other job data that came out last week was the JOLTS job openings data. Now this surprised to the upside with 372,000 new job openings being created. But if you look at the chart, although it blipped high, you can see it's a consistent trend lower here.
Yeah, I think, as you say, this is a mixed picture. And whilst this one solitary piece of information is an uptrend, the overall trend has been downwards. And if you were to look at the popular job search site Indeed, we're actually seeing new job postings on Indeed at their lowest levels since the end of 2020. So at the sort of middle of the pandemic levels, which is rather worrying. And if you look to the US's northern neighbor in Canada, unemployment's rising there. So we saw a 6.8% figure for unemployment in Canada in the month of November. So slightly worrying signs for employment in the Northern Hemisphere.
In fact, talking of Canada, we have the central bank meeting from the Bank of Canada on Wednesday, and there we got 48 basis points of cuts priced. So the market's expecting them to do a full 50, basically. And
shows that they're recognising perhaps issues with unemployment, etc., and need to intervene to steady the ship.
Absolutely. And the key point was the market reaction. And what we've seen last week, moving on, is bond yields falling. So the market's now reacting to the news that's coming out consistently weaker than expected. And we also saw the other big piece of data of the US, ISM Services PMI. And this fell sharply from 56 to 52.1. So it's still in expansion, but that's a big miss. Expectations 55.7. And again, service sector's 3 times bigger than manufacturing. Manufacturing's been in contraction for over 20 months, but this was a big shock to the downside.
Yeah, I mean, not to absolutely reiterate everything you've just said, but this is a really important headline with the services being such a large proportion of the US economy. And I think a lot of people were hoping for any losses that the manufacturing sector had been sort of had been suffering to be outdone and perhaps made up for by services. Whilst it's still in an expansionary phase at 52.1, I think a lot of people were rather dissatisfied with this figure.
Absolutely. And if you look at the subcomponents, new orders were down, employment was down, and prices paid were up. So that's the worst of all scenarios for the Fed. And the impact of that, looking at the chart, the 2-year yield, you can see yields, as I say, are now coming consistently lower. And the market had been pricing just over a week ago, 50-50, whether the Fed will cut rates at the next meeting. Well, now for the 18th of December, that's next Wednesday, the market's pricing 21 basis points of cuts. So pretty certain the Fed will cut 25. They don't like to disappoint market estimates. More central bank rate cuts coming. And there was mixed signals from central bank speakers last week. Powell was slightly less dovish than previously. He said we can afford to be cautious as we try to find neutral rates. While Fed's Waller was very dovish, saying he thinks policy is significantly restrictive even after 75 basis points of cuts.
Yeah, and I suppose one of the interesting subplots amongst this is the reaction of the president-elect Donald Trump and Jerome Powell. Trump did not appear to be a huge fan of Powell in his first, in the run-up to his campaign. And I think a lot of people were thinking that Powell and Trump would not coexist. But headlines coming out this week indicating the exact opposite. And Donald Trump quoted as saying he has no plans to replace Federal Reserve Chair Jerome Powell once he returns to the White House, saying, quote unquote, I don't see it. So perhaps they'll be persisting. Perhaps Trump will be continuing with an independent Fed and with Powell at the helm.
And what I see with Trump, his policies that he's come out with so far and the candidates he's put forward, Elon Musk and the DOGE, has been very popular. To dethrone or sack effectively Powell would be pretty unpopular, pretty...
Yeah, I think a lot of people would see that as, perhaps wielding authority too much. And,
Exactly.
the
Very
appointments
extreme.
that he's entitled to make, it's understandable that perhaps he's going against the establishment and going in a new trend. I don't think people are overly surprised by that. But if he were to really try and sort of flex his muscles and overextend perhaps what some people would see to be within the remit of a president, that could cause huge protests, I'm sure. So I'm sure it's quite tactical that he's keeping Powell there. Whether he likes him as a person or not remains to be seen. But I think we'll be seeing this relationship continue.
I think where it becomes controversial is if when Trump's in office, the economy starts to weaken. And then Trump will make it clear he thinks they should cut aggressively.
Yeah.
And whether Powell bends to those words, that's when it becomes more interesting. On to data out of China over the weekend. Deflation continues. CPI came in down 0.6% month on month. CPI year on year is 0.2%, again way below expectations of plus 0.5. And PPI, Producer Price Index, came in down 2.5%. The 10-year government bond in China continues to fall, hitting all-time lows, 1.95%. This is pretty bleak. We had the big stimulus in, was it September or October now, but recently.
Yeah, it's a period of Chinese interventionist government policy. It's a drawn out and protracted set of policies that aren't going to make immediate impacts always. Yes, they can feed through into things like equities very fast, but in terms of getting consumer consumption to increase, this is a slower moving barometer. This is whilst it may sound as though we're repeating ourselves week on week here, it's just nature of the issue with China and also a nature of the medicine. I'm not surprised that we're seeing weak demand and falling into this deflation period. It's a problem that their neighbours in Japan have suffered for many years, and China was very much the outlier for the majority of the 2000s, etc., with fantastic growth year on year. Things haven't been moving up more recently, and now we're in a bit of a downturn, and I don't think it's going to be resolved immediately at all.
Yep, a word that keeps coming up last week I keep seeing is Japanification. Quite a tongue twister, I got that out. And the other point, of course, is the time lag in central bank in monetary policy. In the US, it's seen as 6 to 9 months for monetary policy to feed through. In China, it may be a longer time than that.
Yeah, absolutely.
People's investments tied up in property, which has continued to go down.
It's a classic thing that's also said about some of the Eastern economies, is that a lot of people have a different propensity to save than they do in Western economies. Western economies seem to be far more built upon credit and taking out loans. So as a result, people are more responsive to changes in things like interest rates from the government, but also to stimulus packages. I'm sure the Chinese policymakers are not particularly keen for any stimulus that they give to just be saved and stored, and they want that stimulus to be seen in the real economy.
Definitely. Moving on to Japan. Japanese salaries have seen a record gain. That's key because the central bank governor Ueda has tied central bank policy quite tightly to wage expectations going forward. There's a BOJ meeting on the 19th of December, and the market's pricing in 8 basis points of hikes. So while other central banks are cutting, Japanese economy still has inflation rising. They're going to be raising rates. We'll talk a bit later about currencies, but what we're seeing now is yen strengthening across the board, while other currencies weaken against it. That's a popular trade at the moment. We highlighted last week euro yen as a downside, and then I was reading on Tuesday that that's a key trade favoured by hedge funds at the moment, shorting euro yen.
Yeah, I think the forex impact upon the Japanese economy is definitely one to be paying a lot of attention to right now. We're looking at some of the Q3 data that's just been revised, that's come out. So it was saying that net exports and private inventories were revised up from their preliminary estimates, which sounds all fantastic. But private consumption was revised down. So I'm sure the net exports will be, having been bolstered by the death of the carry trade, the FX impact upon the yen versus the dollar, etc., etc. But yeah, private consumption, which is a far better signal of domestic demand in domestic currency being revised down, worrying. So you have your yin and you have your yang.
Yeah, I remember I lived in Japan 20 plus years ago, and people always said then how expensive it was to be a tourist. Now you're hearing completely opposite.
It's cheap
People
to be
saying
a
how
tourist.
cheap it is to be a tourist.
Yeah.
Amazing how many people are skiing there at the moment.
Yeah, absolutely.
On to France. French political turmoil continues. Barnier, vote of no confidence, driven by Marine Le Pen. Euro dollar is at 105.65. It needs to go lower. The ECB need to detach from the Fed. They need to cut more aggressively. They need the euro subpar. And also you can see from the chart, French 10-year risk continues to widen over Germany. We mentioned last week, French 10-year bonds have a higher yield than Greece. Unheard of.
Absolutely, and I would expect it, however, to continue and to perhaps even supersede Greece, because with this political uncertainty going on, I would have thought that even if Le Pen were to get into government, it wouldn't necessarily be smooth sailing, as whilst she is popular amongst some diehard fanatics and her popularity has reached more of a mass audience than it had previously. I think if we were to see a more right-wing Le Pen government, you would see protests equal and opposite on the sort of left in France. So I think, we're going to be in for a period of political upheaval in France, which will be fed into the economy as we see here, and the risk spreads will continue to rise, perhaps against Greece, but likely against Germany as well. Germany also going into a snap election in February.
Absolutely. And when we talk about dollar strength against the euro, we spoke about the yen strength at the moment. Dollar yen's around 150 and going sideways, but the dollar is doing well, continues to strengthen against the Chinese one. It's at 1-year lows. And Indian rupee and Brazilian real both continue to drop to all-time lows. On to Germany. You mentioned Germany. German industrial production fell 1% month on month, expected to rise 1.2. Again, a big miss here, and more woeful economic data out of Germany.
Yeah, it missed, didn't it, on all of its industrial production measures. Devastating news. And then another sort of piece of information that I saw doing the rounds today. We've been bleating on about German manufacturing being dire for a while now. But if we look at the car manufacturing as one of the former stalwarts of the German economy. So the share of global light vehicle production in Europe, of which Germany was one of the leading participants. In 2011, Europe accounted for 26% of all light vehicle production. It's now just 19%, and it's lost out largely to China in that regard. As things move away more and more from combustion engines and move into electric vehicles, I can see European manufacturing in automobiles, and in particular in Germany, this to be problematic going forward.
And definitely calls for more tariffs.
Absolutely.
Also back to Germany, the DAX finally broken new all-time highs above 20,000. We've discussed this before. The equity market is not the economy. We just said how weak the economy is, and we have equities at all-time highs. Interestingly, the growth isn't due to higher profits, but rather increase investors or what they're willing to pay for stocks.
Yeah, I think obviously you can see equities markets being buoyed and doing quite well when that is deemed to be a great store of wealth or have potential upside. So for those that do have money that they're able to squirrel away and save, we're in a relatively high inflation environment or had been for some of the previous few years of regime. So people might be looking at things like equities, and then your Bitcoins and gold as well as a better store of wealth than having money in the bank or, just spending now. Demand seems relatively poor. So I think we're perhaps seeing substitution for consumption in demand to equities.
Definitely. And staying in Europe, weaker UK data across the board. Manufacturing PMIs fell, retail sales fell, business confidence all fell. So manufacturing PMI fell from 49.9 to 48. That's pretty clear contraction now. The BRC retail sales last up 0.3%, fell 3.4%. And BDO, business confidence, they're saying it's the weakest since January 2023 as businesses face rising costs, reduced consumer confidence and falling orders. And you can see from the chart here, this is sterling against yen. And you can see we had the clear peak in the first half of the year. And we've had a bounce off the trend line, but it looks like that's going to break lower in the medium term.
Yeah, and just to further contextualize this business confidence measure, whilst it's not necessarily as straightforward a metric to point to as others, and it's often used gathered using sort of more interviews and soft topics. This January 2023 low was also pretty much on parity with one of the COVID lows. So we're really at a point of serious worries in terms of business confidence if it's on parity with January 2023 and some of the COVID lows.
Yeah, and while I feel like some of the other data has been repeating itself, weak Germany, weak France, the UK economy had been consistently holding up. Now we're finally seeing the cracks suddenly coming in.
Yeah. And then, just in terms of the UK's relation to the Eurozone, it was one of Rachel Reeves's announcements over the weekend was that she wanted to basically reset relations to some degree with Europe, quote unquote, wanted to break down barriers to trade as well as businesses selling in each other's markets. So this, she's ruled out Labour leading the UK back into the EU, which I think, amongst some people would be a popular decision, amongst some people would be a wildly unpopular decision. But yeah, it sounds as though the UK feels as though it's in need of really propping up its economy, reducing any barriers to trade. This could be of significance going into a high tariff environment with trade with the US. But if you're looking at all of this data coming out of the UK not sounding too positive, European manufacturing not sounding very positive at all, perhaps it's latching on to the putting its money on the wrong horse here.
Interestingly, we have lots of central bank meetings coming up. Next week, the 19th, the Bank of England, only 2 basis points of cuts price. So the market's saying central bank's not going to cut rates. There are 77 basis points of cuts priced over the next year, but while other central banks are cutting aggressively, the market isn't expecting a cut right now. US equities continue to make new all-time highs, the NASDAQ and the S&P. Investors rushing into funds. In fact, a staggering amount. Investors have pumped almost 140 billion into US equity funds since last month's election. The busiest 1 month inflows stretching back to 2000. That's a staggering chart.
Yeah, and I think you'll see continued support here in US equities, and the tech sector amongst US equities also has been just performing very well steadily, whilst I think it's fair to say Europe has floundered in that sector.
Yep. And the US stock market now makes up 63% of the global market cap, up from 60.5% at the beginning of the year. The next biggest country is Japan. The Nikkei is 5.6%. That's huge. And actually, more worrying perhaps, ETFs, the S&P 500 ETF daily trading volume plunged to 26.9 million on Tuesday, near the lowest since 2007. So money's come in, but we're seeing volumes plunging now. S&P futures trading volume fell to the lowest in 3 years last week, and VIX volatility is now the lowest since July. I guess we'd expect that going into Christmas period. But the market, as we say, it's expensive. Price to book ratios are actually back at 2000 highs.
Yeah.
But it's still trending higher.
Yeah, I mean, you can have, I think it's very easy to try and figure out solutions for why we're seeing lower volatility. Whether the truth is within those conclusions is correct, I don't know. But it's very possible that people that have made money are happy to sit on the money they've made, whether it be based in gold, crypto, equities, etc., and could perhaps be in a risk-off kind of attitude going into, number one, Christmas, number two, you're going to be having Chinese New Year holidays coming up before too long. So that is a logical explanation for why we're seeing low volatility. Perhaps there might be other reasons at play as well.
But that's still a staggering amount of money flowing into equities.
Yeah.
We haven't spoken about Australia for a while, but we had weaker than expected data last week. GDP came in at the lowest since the early 90s recession. Amazing that we've not seen a recession in Australia since then, but weak. So data came in up just 0.3% quarter on quarter, up 0.8 year on year. As I say, lowest since the early 90s. Again, the chart here is Aussie yen, very similar to sterling yen. We've seen a sell-off. This is a daily chart. It's hit the long-term trend line going off daily closes. It's opened, it's bounced today, but that trend line looks like it's certainly under threat. Any more weaker data, central bank cutting rates, then we would see that definitely break to the downside. Again, 6 months ago was all about yen strength. Yen weakness. Now the currency markets, all about, well, dollar strength against the BRICS, but also yen strength with the central bank raising rates. In fact, the OIS is pricing in 46 basis points of hikes by the Bank of Japan over the next 12 months, while the other G10 countries are all cutting. Bitcoin had a volatile week. It traded above 100,000. I last looked this morning, it's 99,500. But one day last week, it traded from 103.8 thousand down to 90.5 thousand. So what's that? That's about a 14% move in less than a day. Something to remember here as well, while people are talking about investing in crypto, over the last 10 years, the biggest drawdown in gold has been 22%. That's the only drawdown in gold over 15%. Meanwhile, in the last 10 years, you've seen 3 big drawdowns in Bitcoin, down 78%, 82%, and 55%. So again, it's trending higher. We're in a consolidation period, but again, treat it with the risk that it deserves.
Yeah, I think one of the calls that I had made last week has been completely disproven here, because I think I was of the impression that there'd be a lot of people that were willing to sell as things sort of flirted with the $100,000 mark, and that it probably wouldn't break $100,000 in this previous week. It did, and one of the major headlines for why it did surpass $100,000 was this appointment of Paul Atkins to take over as chair for the SEC. So Aikens himself, he's a crypto kind of guy. He founded the risk consultancy firm Patamac Global Partners. So that was 2009. They have quite a few cryptocurrency interests there. So I think the market definitely saw this as a very bullish crypto headline. And yeah, it broke that $100,000 mark, but it didn't then, shoot off and rally another 10% beyond that. So there still seems to be a bit of a range here. The upper and lower bounds of the range are perhaps going to be consolidating in quite a wide remit between maybe $105,000 on the upside and $90,000 on the downside. But there's still a huge amount of notional volatility within Bitcoin.
That's crazy volatility, but that comes with the product. And he's, of course, is taking over from Gary Gensler, previous head of the SEC, and before that, head of the CFTC. He was seen as more of a skeptic, but having said that, he lectured at MIT Business School on the role of cryptocurrency and distributed ledger. So he was certainly well versed in the products. Copper, again, another chart trending higher, bouncing off a trend line. We discussed last week the key trend line here, whether it would break lower, and it's actually hasn't broken lower. It's bouncing, it's trending up from here. So I'll be keen to see where this demand is coming from, but certainly that seems to be trending up for now. A clear stop loss level just below the previous swing low and trend line.
Yeah, we spoke about the low volatility environment in US equities, but we're very much seeing a low volatility environment in Brent. And if you look at the chart here, you can really see, for anyone watching, you can see the convergence of the Brent price between these trend lines. Macro headlines are, really falling on deaf ears, I think it's fair to say at this point. You're seeing that there was, perhaps a bullish headline over the weekend with the announcement of Bashar al-Assad's deposition in Syria and his fleeing to Russia. This Assad government in Syria had previously had quite firm Iranian ties, and with his removal in Syria, we have now this morning seen a headline of an Iranian tanker having to turn ship and go back. So in theory, this could cause, risk premiums within the Middle East to rally, and that would fundamentally be bullish flat price. But we saw Brent open higher this morning, but it didn't break out higher, and it has steadily lost some of the gains it made in the early hours of trading. And likewise, for every bullish headline you get a bearish headline as well. It sounded as though over the weekend Macron brokered a bit of a meeting between Zelensky and Trump, which was one of the first meetings between Trump and Zelensky since Trump has been formally elected president. So it sounds as though Trump is going to be very interventionist and isn't keen for the war between Russia and Ukraine being prolonged. This might have an opposite, a bearish price impact on crude if Russia were to be, seen to be playing ball, and the removal of sanctions between the Western countries and Russia on oil. So there might be a breakout to the downside, because all of these bullish headlines about risk premiums in the Middle East going on, they just seem to fall on deaf ears. So yeah,
that would be seen as a huge victory for Trump as well.
Yeah,
if he came into power and he could manage to broker
absolutely
peace settlement. And if we go back to that chart, you can see the highs and the lows. The low here is $13.63. The high is $138.3. So you can see it's a huge range, and you can see how we got those converging trend lines. And you can also see at 70.5, there's multiple lows over the last 2.5 years pretty much now. But again, if it breaks down from here and closes below 70, then purely technical traders will come into the market and start selling, whether they're long or whether it's new shorts. A break lower, a small break, a close below 70, you would see potentially an aggressive move lower. Onto gold. We haven't been at the gold chart in for a few weeks. It was the great chart of the first half of the year, up something like 40% earlier in the year. But again, similar trend line here, moving higher. Gold's bounced off it on the news that the Chinese central bank has resumed buying after 6 months on the sidelines. Again, we'd want it to see breaking above the previous highs to get more confidence, but certainly it's bounced off that trend line. And if you're long, there's a clear stop loss. A slightly bigger, longer term story, macro story, is the aging population. Elon Musk last week put out that, highlighted that in Singapore, the birth rate has hit rock bottom, just 0.97 kids per woman, far below the 2.1 needed to sustain a population. That tweet has had yesterday over 11 million views. That's more than double the Singaporean population. But this is a bigger story, ongoing story, that actually Europe, North America as well, Asia, these countries need migration.
Yeah, absolutely. I think within the UK, the figure that came out a month or so ago was that native-born Brits, the death to birth rate was actually negative. More native-born Brits were dying than were born, and yet there was population growth. But this was, this is a manipulated figure ultimately, because that population growth was coming from immigration rather than the birth rate sustaining the population. And I think, this is very much, people have seen the Christmas tree populations in Japan and South Korea and all of this, but this is a problem that is making its way into the West now for sure.
And we'll just keep hearing more and more about this in the months ahead. So on to central bank pricing. Say we have plenty of meetings over the next week. Wednesday, Bank of Canada expected to cut 48 basis points and 128 over the next year. Thursday, the ECB meeting, 22 basis points there. They'll almost certainly go 25. It would be surprising if they went 50, but it's not there's no zero possibility of that. SMB also on Thursday, 36 basis points of cuts priced there. Again, SMB, 92 basis points priced over the next year. And in a year's time, the market's flirting with whether they'll have negative rates again. Next week, we have the Fed on Wednesday, 21 basis points, so a cut priced there. Nothing from the Bank of England. And on Thursday, also the Bank of Japan, 7 basis points of hikes priced. And to finish with an equity chart, an interesting chart here highlighting the semiconductor ETF and the tech ETF, how they're moving in different directions now. It seems like we've seen a top in semiconductors. Nvidia is going sideways, but certainly the semiconductor ETF, it's a great correlation between the two, but clearly breaking here. And it'll be interesting to see going forward if that will weigh on the NASDAQ. So key data this week, well, outside of the central bank meetings, really it's just US CPI on Wednesday and US PPI on Thursday. So that wraps up this week. Thank you for listening, and we will have one more Macro Monday next week, the last one before we break for Christmas. Hopefully we'll see you then, and have a great week. Thank you.
Thank you very much.